Advanced Financial Accounting PowerPoint presentation. In this presentation, we will discuss other foreign operations issues. Get ready to account with Advanced Financial Accounting. Other foreign operations issues. So we're going to start off with an issue related to the parent company having a foreign subsidiary. Typically, when that is the case, they're going to have to consolidate. In other words, you're going to have to get the foreign subsidiary books in some way to the US dollar and then do the consolidation process. However, you might have a situation where that wouldn't take place under certain conditions. So, parent generally consolidates a foreign subsidiary except when certain conditions are so severe that the U.S. company owning the foreign company may not be able to exercise the necessary level of economic control. So notice when we think about the consolidation process, we'll typically think about we need to consolidate the entities if there's control, right? Over the 51% is going to be the general rule, but the overarching concept is that there is control. Now, if there are certain conditions, even though it's the ownership is over the 51%, we would think there would be control, but there's certain conditions in the foreign subsidiary that are restricting that economic control, then they might not meet, that condition, and therefore in that situation you might not have the consolidation process. So in that situation, then you might have a parent company that has basically a controlling interest, you would think, in terms of the stock, but you're not having a consolidation due to one of these factors limiting the actual economic control. So those include restrictions on foreign exchange in foreign country. So severe restrictions there could be one of the items that would stop the basically consolidation process possibly. Restrictions on transfers of property in foreign country. So if you can't transfer the property, that could be another barrier to having the actual economic control. Large government imposed uncertainties. So if we had other basically uncertainties due to the foreign government, that again could have consequences in terms of the economic control of the parent company to the subsidiary. So unconsolidated subsidiary. So what do we do then? We have the subsidiary that you would think would typically be consolidated, but now it is unconsolidated due to one of these conditions. Well, how are we gonna report that subsidiary then? So reported as an investment on the U.S. parent company's balance sheet. So as we would expect, we're still gonna report it, the investment on the balance sheet. So the parent company has an investment in the subsidiary that we will typically report on the balance sheet just like we normally would, but then when we go through the consolidation process, we typically then consolidate that out and report them in a consolidated report. So we would still be reporting their investment on the balance sheet. The equity method is used if the parent has the ability to exercise significant control. So we said now we don't have enough control basically to do the consolidation. However, if you still have significant control, which was over like the 20% or so, then you would think then if they would have consolidated, but they're not consolidating due to one of these factors, they would generally still have significant control and therefore be recording their investment in the subsidiary with the use of the equity method. When using the equity method, the investee's financial statements are either remeasured or translated depending on the determination of the functional currency. So we still have that process of remeasurement or translation depending on what the functional currency is of the foreign subsidiary. The cost method will be used if the equity method cannot be used. So if you can't use the equity method, which is the one you would think would be used if you had significant influence, then the cost method would be used. Liquidation of foreign investment. Liquidation of foreign investment. The translation adjustment account is directly related to the company's investment in a foreign company. When the investor sells a large portion of the stock investment, the pro rata portion of the accumulated translation adjustment account attributable to that investment is included in computing gain or loss on the disposal. So it's going to be one of the key factor here is you got to include that in the calculation. So once again, when the investor sells a large portion of the stock investment, the pro rata portion of the accumulated translation adjustment account attributable to that investment is included in computing the gain or loss on the disposal. Hedge of a net investment in a foreign subsidiary. Gain or loss on the effective portion of a hedge of a net investment is taken to other comprehensive income as part of the translation adjustment. Amount of the offset to comprehensive income is limited to the translation adjustment for net investment. And then the difference, if there's any excess on the affected portion, on the effective portion, it will be recognized in the earnings. So then we have the disclosure. So we're going to take a look at some of the disclosure issues here. The aggregate foreign transaction gain or loss included in income needs to be separately disclosed in the income statement or on a note accompanying it. If it is not disclosed in a one-line item, which you think, you'd have a one-line item on the income statement for it, but if that's not the case, then the disclosure will usually be a one-sentence footnote that will need to be included. So then we have the statement of cash flows. Amounts reported will be restated in US dollars using the same rates as used for income statement purposes. So statement of cash flows is going to be a timing statement. So, and you can see it's kind of related to the flow process, which is the income statement. Another timing statement has a beginning and an end. So you would think we would be using the similar accounts there or rates for the translation, which would be, usually the default would usually be the average rate, unless you have to use the historic rate if you're using the remeasurement process and whatnot. So a balancing item for differences in exchange rates will appear on the statement of cash flows. Inventory valuation, lower of cost or market. So now we have this lower of cost or market issue when we have basically foreign subsidiaries involved. Historical cost will be remeasured using historical exchange rates to determine the functional currency historical cost value. The remeasurement costs are then compared with the net realizable value or market value of the inventories translated using the current rate, and then we can compare the cost and the market, which are now both in the functional currency. So we got to get them both in the functional currency. Once they're in the functional currency, then we have our normal kind of process for the lower of cost or market. So to identify the appropriate write-downs to market that are needed. So obviously we're going to apply the lower of cost or market. We got to make sure that we get the items in alignment with the functional currency so that we can make the comparison and then make the write-downs when necessary. Intercompany transaction example. U.S. company has foreign currency denominated receivable from a foreign subsidiary. So once again, this is an example of an intercompany transaction. We have a U.S. company, so where the parent company is a U.S. company, has a foreign currency denominated receivable. So we've got a receivable that's denominated in foreign currency. So the parent company is going to be receiving a receivable from a subsidiary, but that receivable will be received in foreign dollars, so from a foreign subsidiary. So that's the example. U.S. company will need to revalue the receivable to U.S. dollar equivalent value as of the date of the financial statements, which is basically standard procedure, right? We got the receivable on the books. We're gonna have to remeasurement to the date, the rate at the date of the financial statements for the receivable. Once the foreign affiliate's financial statements are translated or remeasured, the receivable will be at the same US dollar value and can be eliminated. So once that has taken place, we'll have the same US dollar amount reported on there after we have translated the subsidiary account and after we have remeasured to the current time period the account on the parent company books, and then we can remove them in the normal process we would for an intercompany transaction related to the receivable, meaning the receivable would go down on one side of the books, the parent side of the books, and the payables would go down on the other side. Obviously the complication there is making sure that we have equivalent amounts after we do the exchange process. So then once we have both amounts recorded, basically in terms of the US dollar, after we have done either the translation or remeasurement, then we should be able to eliminate that in a normal way. There is an exception if the intercompany foreign currency transaction will not be settled in the foreseeable future. So if it's not going to be settled in the foreseeable future, that's going to be unusual. There could be an exception. The transactions can be considered as part of net investment in the foreign entity. Transaction adjustments on these long-term receivables and payables are deferred and accumulated as part of the cumulative translation account. Income taxes. So we talked about income taxes in the past when we had the combination, but now we have got the added problem of the foreign subsidiary here that could complicate the income taxes a bit as well. So whenever temporary differences exist in the recognition of revenue and expenses for income statement purposes and for tax purposes, interperiod tax allocation is necessary. Deferred tax assets or liabilities will result from exchange gains and losses from foreign currency if they are included in income but not recognized for tax purposes in the same period. So that a deferral is necessary for the portion of the translation adjustment related to the subsidiary's undistributed earnings that are included in the parent's income.